Watching a market crash can be devastating, especially if your own portfolio is hit. Trust me, I know the feeling. The stock market is a ruthless battlefield, and if you go unprepared, you'll get slaughtered. In this video, I'll cover the 6 most powerful tips on how to invest in stocks. If you are a beginner, you'll get tons of insight that has the potential to change your financial future. I'll teach you how to get the right mindset for investing, how to choose the right area for investments, and how to choose the right stocks at the right time. Now, even if I know all of this content is invaluable for you as a new investor, there's this thing with YouTube that 90% of you will turn off the video before the end. If you want to be among the 10% smartest, I'll show you the most powerful financial force and how you can take advantage of this to really skyrocket your investing. Let's get into it. First off, the one thing that is separating the seasoned investor and the newbies is the ability to handle emotions. Emotions in investing are dangerous since you are prone to make irrational decisions. Over the last 20 years, the market had 2 bear markets and 2 bull markets. The 2 bear markets were approximately 50% down, and the last bull market was one of the best in history. All in all, the market went up 6.6% per year. How come the average investor got only 2.5% per year? The reason behind the underperformance is because most do the wrong thing at the wrong time. This means buying too much in excitement when stocks are high and selling in panic when it seems like the world is about to end. The decision making is usually related to emotions. It is important to know about this, as it will enable you to handle the situations. And to paraphrase Ray Dalio, I can guarantee you one thing. Every asset class will likely go down 70% once or twice in our lifetime. The key principle here is that you have to be able to tolerate a 70% decline in the markets. If you can't, you better not be invested in stocks. Now, the good news is that this is a mindset problem. Instead of panicking when the market is crashing, you should think like Warren Buffett. If stocks go down, you buy more. If stocks go up, great. Second, choose an investment area where you are competent. It's easy to be carried away by trends and hype, and it can make you buy businesses you don't fully understand. My message to you is that you can find great businesses by simply looking around you, at the place you work, within your circle of competence. If you are a big fan of a certain product or service and you know that you are an early adapter, maybe you should look into the stocks of the company as well. I still remember how more than 20 years ago, I bought the first iPod from Apple. I just love the product, and I noticed that more and more people around me started to pick up the iPod as well. I didn't think about the stock at the time because I was occupied with other projects, but I think the chart tells the whole story. 20 years ago, Apple was at 25 cents, while now it is above $140, an increase of 55,900%. Let's just not talk about that anymore. Okay, third, before you buy any stocks, you should know the rules of the game. Imagine if I asked a random person to play a game of poker with no experience from the game. We would each put in $1,000. Now, would that be a wise decision? Of course not. The guy would be stupid to risk $1,000 if he didn't know the rules of the game. It's the same way with investing. You'd be amazed at how many new investors that don't spend any time researching what they are doing. The end result is often that they lose a lot of money. Luckily for you, if you're watching this channel Profit Protection, my goal is to teach you the fundamentals. So while we're at it, hit the subscribe button to support us on our mission. Okay, this is what you need to know. Net worth is simply the difference between your assets, what you own, and liabilities, what you owe. Cash flow refers to the net balance of cash moving in and out of a business at a specific point in time. The P/E ratio, or price to earnings ratio, may be one of the most important metrics in investing. The P/E ratio simply is the stock price divided by the company's earnings per share for a designated period like the past 12 months. You need to know this stuff before investing. Now, fourth, so when you know the rules and are finally ready to buy stocks, you should do this. Buy wonderful businesses, not cigar butts. It's often the case for gurus online to be hyping up a stock that is, for lack of better words, complete trash. There are plenty of voices online that want you to buy subpar companies off of rumors or chart patterns. When you buy a stock or digital asset, you want to be able to hold it for years. Warren said it best.
I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50, it made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price.
Okay, so the fifth tip is key. Pick the right stocks at the right time. It might sound obvious, but it's not. I want to draw your attention to this chart. It's a graph from Fidelity, which tells you what type of sectors do well in different parts of the market cycle. When the market is starting to go down, you want to play the game defensively. You want rare metals like gold, which holds its value. You'd also want consumer staple stocks. Also, you want to consider the energy sector. When the market is contracting, like in a recession, you want to adjust your strategy slightly. Consumer discretionary and healthcare are the ones to go for. This is still needed no matter what market we are in. Now, when the market is bottoming out, you need to reposition into financials and technology because they are the ones that get beat up the most during the crash. You normally get them at a ridiculously discounted price as no one wants to own them. When the market is recovering, industrials, technology, and consumer discretionary are sectors to keep an eye on. Okay, so the sixth advice I give you as an investment beginner is probably the simplest rule to investing, but the hardest one to follow. Now, before I go into that, if you've learned anything from this video, make sure to like it and subscribe to our channel. It really motivates me to keep up producing content like this, and best of all, I can continue to give you investment insights for free. Okay, so the tip that is simple to understand, but probably the hardest to follow is this. Ignore the short-term swings. Most investors are obsessed with the day-to-day or minute-by-minute price action of a stock. Benjamin Graham said, the investor's chief problem, and even his worst enemy, is likely to be himself. And this is so true. If you get obsessed with following the price fluctuations of your investments, you'll likely get emotional. And we know that already. You should avoid everything that can turn on your emotions. Luckily, this is also just a mindset problem. You should think of it this way. How often are you checking the price of your apartment? You wouldn't do that every day, right? Or every hour for that sake. You'd probably have a diagnosis by then. But still, with stocks and other financial instruments, people tend to check the price every so often. Now, just because the information is available doesn't mean you should look it up every day. If you are a long-time holder like Warren Buffett, you should check it once a year at the most. You don't care about the short-term swings. Okay, so the seventh and final thing you should be aware of as a beginner in the investment game is this. Know the effect of compounding interest and take advantage of this. You truly don't want to miss it. There's a famous legend about the origin of chess that goes like this. When the inventor of the game showed it to the Emperor of India, the Emperor was so impressed by the new game that he said to the man, "Name your reward." The man responded, "Give me 1 grain of rice for the first square of the chessboard, 2 grains for the next square, 4 for the next, and so on." The Emperor agreed, amazed that the man had asked for such a small reward, or so he thought. After a week, the king realized that he was unable to fulfill his promise because on the 64th square, the king would have had to put more than 18 quintillion grains of rice, which is equal to about 210 billion tons. It is sufficient to cover the whole territory of India with a meter-thick layer of rice. This is the power of the compounding effect, and Warren Buffett is probably the best-known investor to take advantage of it. He calls it the snowball effect. So the key question is, how do you take advantage of this yourself? One strategy is this. Take profits from your investments regularly. Don't get greedy, and put your profits to work by reinvesting it. Now, you don't actually have to sell your shares to do this. As you remember, you should have a long-term view on your investment and not worry about selling. The way to do it is by investing in dividend stocks. These are stocks that regularly pay out dividends to their shareholders. One example is 3M. They currently pay out a nice dividend yield of 3.54%. That may not sound like a lot, but remember the effect of compounding. The other thing about 3M is that they have increased their annual dividends for more than 60 consecutive years. So it's fair to say that their dividend is reliable. So what you would do is to reinvest all the dividends and the snowball will start rolling. Now, the important thing to remember about this is that you should start early. But if you do, you have the possibility to earn significant amounts of money. Let's, for the fun of it, say you have invested only $1,000 in 3M and had a monthly contribution of $50. You'd end up with more than $85,000 in 50 years. That is nearly 3 times the amount of your own contribution. Compound interest is a tail-heavy process. You really start to see the results only after a certain period of time. The more you wait, the more you get. As simple as that. And that's the reason why Warren Buffett made most of his net worth after the age of 60. If you found this video valuable in any way, please subscribe to Profit Protection. Now, if you want to learn more about how you can utilize the power of the compounding effect, you should definitely check out this video about Benjamin Graham, known as Warren Buffett's mentor. He posted an annualized return of around 20% from 1936 to 1956, and I'll explain to you how he did it. I'll see you in the next one.